I want to ask you something, and I want you to think about it honestly before you keep watching. In the last 12 months, have you deposited a large amount of cash into your bank account? Maybe you got money from a family member. Maybe you sold something, a piece of land, a car, some jewelry that belonged to your mother. Maybe you moved savings from one account to another because you just wanted things simpler. If any of that sounds familiar, there is something you need to know. Something quiet, something the bank will never bring up on its own, and something that catches good, honest people off guard every single year. Not because they did anything wrong, but because nobody ever told them how this works. That is what today is about. Stay with me. I am going to tell you about a man named Gerald. He's 74 years old, lives in a small town outside of Knoxville, Tennessee, retired after 32 years at a manufacturing plant, spent his whole adult life being careful with money, paid off his house, never carried credit card debt, kept a savings account he barely touched. When his wife passed 2 years ago, he inherited a small life insurance payout. It was not a fortune, just enough to matter. He wanted to put it somewhere safe, somewhere he could see it, so he transferred the money in a few installments over a couple of weeks, easier for him to manage while he was grieving, while the paperwork was still being sorted out. 6 weeks later, Gerald got a letter. It was not from the IRS directly, it was from his bank. They needed him to explain the transaction pattern. Gerald had never received a letter like that in his life. Federal law requires your bank to file a report anytime a cash deposit exceeds $10,000. That report goes to a federal financial agency automatically. The bank does not call you first. They do not ask your permission, they just file it. Now, and this is important, that report by itself is not an accusation. It is not a red flag. It is not an investigation. Banks file millions of these every single year, and the vast majority of them are never looked at by a human being. So if you deposit $11,000 and the report gets filed, you have not done anything wrong. You are not in trouble. That part of the system is completely routine. Here is where it goes wrong. Years ago, word started spreading, through neighborhoods, through family dinners, through well-meaning friends, that you could avoid that report by keeping your deposits under $10,000. People heard it and thought they were being smart, so they started splitting deposits. Put in $9,800 this week, $3,500 next week. Have their spouse deposit part of it at a different branch. Break it up so no single transaction hit the number. What those people did not know, what almost nobody warned them about, is that breaking up a deposit specifically to stay under that reporting threshold is itself a federal offense. It has its own name. It is called structuring. And the brutal part of it is this: it does not matter whether your money is completely clean. It does not matter if you earned every single dollar of it over 40 years of honest work. The moment you intentionally split a transaction to avoid that report, you have crossed a legal line that federal law takes very seriously. People have had accounts frozen over this. People have paid significant penalties. And almost none of them believed they were doing anything wrong. They thought they were being careful. That is the tragedy of it. I want to walk you through the 3 situations where this actually comes up most often for people in retirement, because these are real scenarios, the kind that happen at kitchen tables and bank teller windows all across America every single week. The first one is selling something. You have a car you have not driven in years sitting in the garage. A boat, a piece of farmland that belonged to your parents. You sell it privately, the buyer pays cash, and now you are walking into your bank with a significant amount of money. If the amount is over $10,000 and you deposit it all at once, yes, a report gets filed. Your name goes on a federal record. That sounds alarming the first time you hear it. But it is genuinely fine, because you have a paper trail. You have the bill of sale. You have the title transfer. You have your deposit receipt. If anyone ever asks you a single question about that transaction, you hand them those documents and the conversation ends there. What you do not do is go home. Think about it. Talk yourself into breaking it into 2 deposits. One this week, one next week, to keep the bank from filing that report. That is the exact move that turns a completely innocent transaction into something that actually draws attention. The second situation is receiving money from family. Your daughter wants to help with your medical bills. Your son sold his business and wants to give you something. Your grandchildren want to contribute to a big expense you are dealing with. A gift is a gift. It is not income, and as the person receiving it, you do not owe taxes on it. But here is what happens in almost every family when this comes up. Everybody tries to be helpful in the wrong way. Your son says he will send it in a few smaller transfers to keep things clean. Your daughter says just deposit it slowly, a little at a time. Your spouse suggests splitting it across 2 accounts. Every one of those ideas is structuring, and the exposure does not just fall on you. It can fall on the family member who sent it too. What you actually do is deposit it all at once. If it arrives by wire or check, there is already a paper trail, and you are essentially done. If it arrives as cash, you go to the bank and you deposit the full amount. The one document you want to have on file is a gift letter. It does not need to be notarized. It does not need a lawyer. A handwritten note is fine, something that says the person's name, the amount, the date, and that it was given as a personal gift. That letter plus your deposit receipt is all the protection you will ever need. The third situation is the one that catches the most people completely off guard, and it is the one I want you to remember most. Moving your own money between your own accounts. No sale, no gift, just you, consolidating savings that you earned from one bank to another. Maybe you are trying to simplify things. Maybe you found a better interest rate. Maybe, like Gerald, you were trying to get your finances organized during a painful period of your life, and you just want everything in one place. This is completely legal. You are not doing anything wrong. But if you move the money in multiple smaller amounts over a short period of time, even from your own account to your own account, the automated system at your bank does not know that. It sees a repeated pattern of deposits that all fall just under $10,000. That pattern is exactly what the system was designed to flag. It fires off a report. You get a letter. And suddenly you are sitting at your kitchen table the way Gerald was, reading it 3 times trying to figure out what happened. The solution for moving your own money is simple. Do it in one transaction. A wire transfer or a cashier's check from the sending account directly to the receiving account. When the teller asks where the funds are coming from, and they may, your answer is one sentence. These are my personal savings being transferred from my account at another institution. That is it. Do not add more. Do not feel like you need to explain yourself at length. One clear, simple answer. And what you keep on file is a bank statement from the account you move the money out of, showing the balance before the transfer, and your wire confirmation or cashier's check receipt. 5 minutes to save those 2 documents. They protect you indefinitely. Let me also address something that I hear repeated constantly, because it is wrong, and it is the kind of thing that gets people into trouble. The belief that if you deposit $9,900 instead of $10,000, you are safe. You are not. You are actually in a more visible position than if you had just deposited the full amount. Banks are not only watching for the $10,000 threshold, they are watching for the pattern of someone deliberately trying to stay just below it. A deposit of $9,900 is one of the most commonly flagged amounts in the system, because it is exactly what someone who knows about the rule and is trying to work around it would deposit. Repeated deposits that all conveniently land just under $10,000, spread across a few weeks, look precisely like what they are trying to avoid. If your amount is $11,000, deposit $11,000. The report that gets filed on a clean transaction with a paper trail is not a problem. The pattern of someone trying to avoid that report is. There is also a version of this that involves the IRS more directly, and it comes up more in 2026 than it did even a few years ago, because reporting thresholds and enforcement have tightened in ways that most people have not paid attention to. If you sell something of significant value, real estate, investment property, a business, collectibles, and you receive cash or proceeds, that sale may need to appear on your tax return. When your bank records show a large deposit and your tax return does not reflect any income or sale that would explain it, that inconsistency is exactly what draws a closer look. It is not that the government assumes you are hiding something. It is that the two records do not tell the same story, and systems are designed to notice that. The fix is straightforward. Make sure your tax return reflects what your bank records show. If you sold something, report it. If there is no tax owed on it, and in many cases there is not, your accountant can walk you through that. But the story your return tells and the story your bank records tell need to match. Here is what I want you to actually take away from today, because I did not put this together to make you afraid of your own bank account. This rule exists to catch serious financial crime. It was never designed to be a trap for retired people who sold a vehicle or received a gift from their children or moved savings after losing a spouse. But it catches people anyway, not because they are dishonest, but because they got either bad advice or no advice at all. Gerald eventually got his situation sorted out. He had his records, he could explain everything, but it took weeks of stress, several phone calls, and more anxiety than a 74-year-old man who spent his life doing the right thing should ever have to carry. He told me afterward that the worst part was not the letter itself. It was the feeling that a system he had trusted his whole life was suddenly looking at him. He had something to hide. You do not deserve that feeling, and you do not have to risk it. The protection is not complicated. Deposit the full amount in a single transaction, always. Keep the document that explains where the money came from, whether that is a bill of sale, a gift letter, or a bank statement from the sending account. Keep your transfer confirmation. Make sure your tax return reflects what your bank records show. And if you ever get any kind of written question from your bank or any agency, answer it once, answer it clearly, answer it with your documents in front of you, and do not add more than what was asked. If it ever goes beyond a routine inquiry, stop talking and call a CPA or a tax attorney before you say another word. One clear answer backed by paper is worth more than a dozen phone calls trying to explain yourself. Before you go, I want to ask you one thing. Think about whether there is a transaction coming up in your life, a sale, a gift, a transfer, that you have been planning to handle a certain way. Now that you know what you know, does that plan still make sense? If something feels uncertain, drop it in the comments. Tell me your state and your situation. I read every single one, and what comes up most in those comments becomes the next video. Because the questions you have are almost certainly the same questions someone else is sitting with right now, and they deserve an answer too. Take care of yourself. I will see you in the next one.